But I say that to say that I'm concerned a bit on the future of financial planning and how people are doing it. And that's why I've continued to really just polish this method, because it seems to be something that helps not only solve for the client's sequence of return risk, but it also helps the client with emotional risk. Whether you're new to retirement or you've been doing this thing for a while, you probably have a financial plan. You've probably looked at multiple scenarios. I want to talk through a few of the scenarios that most advisors use and really just show you some concerns I have. This has been talked about a bit, but not only that, it depends on how you are investing. So we'll go through that. I'm going to walk through every detail here and kind of take you behind the scenes as an advisor of what I'm looking at and what I'm conveying to my clients. But not only that, just really what my thoughts are here. That you may or may not want to know these things, what's going on up here in my head. Now let's take a look. So if we're looking here at this plan, this is retired Roger, Mrs. Retired Roger. I always generally use them as an idea of who I'm talking about. We're looking at the probability of success, their net worth, all of these different things that you're factoring in when it comes to retirement. And so truly, just to give you a little layer underneath, we're looking at this plan and we're saying, okay, well, how are we figuring up what they have, where they're at, and all of these scenarios? So we'll just kind of give you some baseline here. Let's look at Social Security. Their Social Security is going to be coming in. Retired Rogers, $3,500. Mrs. Retired Rogers, $1,200. They're obviously retired right this second based on this plan. And from there, they're going to have $6,000 a month in retirement expenses. Then they're going to have $8,000 in pre-Medicare, $3,402 post-Medicare once they start there. Net worth, $1,300,000. As if you're looking here, you've got the Roth IRA, $600, and the 401k, $700, 6-7. Sorry, my kids made me do it. So we've got the property paid for, so they don't have any debts. They're going into retirement. $1.3 million in invested assets. They're going to have the Social Securities coming in. And so let's take a look here at their retirement and let's understand what this is looking at. And so if we're looking here, we've got what they call the Monte Carlo analysis. Different softwares run this different ways. This is our planning software that we're using. We call it Nest Egg here. There's multiple other companies that have these scenarios and financial planning softwares that different advisors use. What we're looking at with the Monte Carlo oftentimes is 1,000 scenarios being ran. Some softwares run even more. There's debates here behind the scenes of that multiple advisors are having of, well, how many scenarios is too many scenarios? Where does the water get too muddy and you're not doing what's right for the client? And so with running 1,000 scenarios, what ends up happening is it says, hey, well, we're going to give you a percentage here. And we're going to say that, well, sure, you could have $10 million at the end of the plan. You could have $0 at the end of life. And in where a median line here is, we're going to say, well, you've got 25 to 75% confidence level of having between 0 and roughly 1 million. 1.6 million is the median line with that. So what they're really telling us on this scenario right this second is, and again, these 1,000 scenarios are factoring in all kinds of concerns throughout history, because we know the markets aren't going to just go up. The markets aren't going to just go down. They're going to bounce all around. And one year you're going to have a 20% return. One year you're going to have a negative 10% return. And so what this says is okay, well, you have a 75% probability having $1.6 million. So 75% chance that that's what, really it's going to fall as. But there's also the risk that there's $0. There's also the possibility of having $10 million. It's good. It's not what I would say is, I like using the Monte Carlo. I think it's slightly conservative from some viewpoints, depending on how you're looking at this, especially if you factor in a lot of other scenarios, as well as what I'm talking about is how you're investing. We'll get to that in a minute. And so something you've got to think through is how does this look for me specifically? Now, you've got to really focus on also your investment returns, what this is actually accounting for and saying for your investment returns. This specifically says this client would be getting a 6.9% average return on their investments. So that's helpful to know, because if you're putting in here that you're going to be getting a 9% return and you're betting on that, and instead you're actually getting a 5% return, well, guess what? This Monte Carlo is thrown out the window because it's not accurate whatsoever. And instead it could derail you completely. On the flip side of that, if you take too much risk, and it will show sometimes, let's just look here. I've got this And I'm just going to go on the fly and show you something, and let's just see what it comes up with. Because oftentimes if you have too much risk, it actually, in this scenario here, based on this plan, it actually increased the probability of success. Did a little bit different than what I was going to share, but that's okay. I'm, again, taking you behind the scenes on the fly here and teaching you and talking through this with you. And so oftentimes what I see, though, instead of being 80%, I see that the probability of success goes down because there's more risk in the markets sometimes. And so the Monte Carlo is going to say, well, if you have a 10-year pullback or whatever, or a 10% pullback over a number of years, what ends up happening is you have sequence of return risk. You're going to be pulling assets from stocks that are down, and it lowers your probability of success, but it actually boosts your ending portfolio probability because there's a good possibility if everything works out, you're going to have more money at the end of the plan because you obviously invested more aggressively with hopes of a higher return. So that's one way of looking at this. The other way of looking at this is oftentimes the cash flow analysis. And the cash flow analysis in general, think of an Excel spreadsheet. What we're looking at here is just a general breakdown of what they would be spending. So as you can see, retired Roger, Mrs. Retired Roger, roughly $100,000 a year, and then Social Security starts, and then they drop back and they're only spending, between roughly $50,000, $45,000, $50,000 a year in retirement years. Now you've got to factor in other things that come into play. Now, I'm not going through this specifically in this video, but you want to look and make sure. So from a plan distribution, this column where it says plan distribution, you've got to be careful there because with that, you could have required minimum distributions. And if you have required minimum distributions, again, that could shift how you're doing things and how you're looking at things with the plan. Oftentimes people say, well, I've got plan distributions, RMDs that I'm having to take. Well, what they're not focusing on is that they're showing they have a positive net flow that year on this. So that means that they're going to be positive on the dollars because they're having to take this money out, this RMD. What ends up happening though is they're not saving those dollars and the plan's assuming that you're saving those dollars, and that is dangerous. So we want to make sure that you're following this on the cash flow, making sure that everything is being accounted for. When it comes to the actual returns, so we talked about the investment returns projected in the plan. Now this shows there's a 6.9% return in the plan. So what this is saying is, well, guess what? Every single year you're going to get 6.9% on your money. Now, so for this scenario specifically, you're taking out money obviously on a yearly basis, but from a withdrawal perspective and an ending balance perspective, as you can see, you've got to have that $101,000 taken out consistently and then it drops down. But then from there, what we want to look at is, let's see here, the ending balance by accounts. Remember, if we go back real quick to the front screen on our analysis is going to tell us that if we adjust this back to current allocation here, our total analysis is going to tell us that we're at a 75% probability, 1.6 million future dollars. We're not adjusting these for inflation right this second. This is just saying, hey, these are future dollars. To compare apples to apples, we go to the cash flow. We say that 1.6 million is what it's projecting there. Well, at the end of the plan here, it's projecting 2.566 million. Reason for that is the cash flow does not factor in sequence of return risk. And when I talk about that, I'm talking about pullbacks in the market. If the market pulls back 10%, well, if you have $1 million, you may only have 900,000 now, and now you're having to sell stocks at a lower percentage or a lower rate. And so that's what this doesn't take into consideration. This is saying, hey, I'm going to get 6.9% every single year. Now we know that that's not the case. Now the Monte Carlo tries to take that into consideration, but truly it's like, well, does the Monte Carlo know exactly your strategy? And that's where I came to truly finding for myself with this, what we call the Two Bucket Powell Method, because this could solve for a lot of sequence of return risk. Now, I'm working on some data on the backside. I'll be able to present that at a later time in other videos, but for just giving you an idea of what this could look like. What if you have a 5-year bucket of conservative dollars over here and you have a growth bucket on the other side? And I've talked about this and helping you understand that you're going to take from the growth when the markets are good. When the markets are bad, you pull from the conservative dollars. If the markets recover, it allows you to then replenish the conservative bucket as well as take from the growth again. And so doing a method like this helps to remove that sequence of return risk, helping you to get more towards that cash flow, which is saying, hey, you're going to get a 6.9% return on a regular basis. Now, the inputs with an advisor and doing this with an advisor, you've got to be very careful because an advisor could say, all right, well, we're going to say that you have, let's just say it breaks down to 70% stocks, 30% bonds. The Monte Carlo is not smart enough to understand that you're going to do the 2 Bucket Powell method. The cash flow analysis does understand that in a sense, but the actual software is never going to understand that you're going to get a hypothetical 7% or 8% return on your growth dollars and a hypothetical 2 or 3% on your conservative dollars. Now, could those numbers be different? Absolutely. We can, talk about that all day long on what returns could be depending on what historical returns are and how you're investing. But I say that to say that I'm concerned a bit on the future of financial planning and how people are doing it. And that's why I've continued to really just polish this method, because it seems to be something that helps not only solve for the client's sequence of return risk, but it also helps the client with emotional risk, because when you're going into retirement, there's a good possibility that your advisor is going to be positioning you into a 60-40 portfolio or a 70-30 portfolio. And they're going to be withdrawing in a down market, and it's going to cost you significantly because of that sequence of return risk where you're selling off stocks that are lower in value. And the other side of that is it's going to hurt you emotionally because you're like, well, I'm having to sell off stocks at a lower value. And so it's really developing something that makes sure that you're looking at the cash flows, you're looking at Monte Carlos, but you're also developing in a plan or a 2 Bucket Powell method or whatever works for your specific scenario to make sure that this is going to meet your needs to live happily ever after through retirement, because that's the ultimate goal. So we'll continue to share more of these types of scenarios. If this was helpful for you, please let us know in the comments.